If the house always wins, shouldn't you just buy the house? Of course, that's not how it works. Welcome back to CasinoLove. This is the 9th episode in our series where we take a factual look at publicly traded companies in the iGaming space. Today, we are looking at Betsson. As always, this is not a financial advice. We are not telling you what to buy, what to sell, or what to avoid. Our goal is to simply look at the company, understand what it does, and go through the latest official information. So first, what is Betsson? Betsson AB is a Swedish public company. It has been a listed company since 1996, has been listed on Nasdaq Stockholm since 2000, and its Class B shares trade on Nasdaq Stockholm large cap under the ticker BATSB. Betsson describes itself as an engaged owner of fast-growing companies in the online gaming industry, with the ambition to grow faster than the market, both organically and through acquisitions. For viewers, the important point is that Betsson is not just a background software company. It is very consumer-facing. The group's global flagship brand is Betsson, but the portfolio also includes brands such as Betsafe, NordicBet, StarCasino, RaceBets, and Risk. The product offering includes casino, sports betting, poker and bingo, and the games are mainly offered through Betsson's own technology platform, which the company says already generates about 90% of current group revenue. That platform point matters. Betsson says its proprietary player account management system sits at the core of the product offering and customer experience, handling payments, customer data, accounts, transactions, and game offerings. The sportsbook is also run on Betsson's own platform and is offered both directly to players under Betsson's own brands and as a B2B solution for external operators. In other words, Betsson is not only running gambling brands. It also licenses technology and services to partners. In terms of scale, Betsson reported 24 local gaming licenses, 20 office countries, and around 2,900 employees. The company says those employees came from more than 70 nations, with operational activities directed from Malta. So even if a viewer has never memorized the Betsson corporate name, this is not a niche operator. It is a large, international group. If we simplify the business model, Betsson has two main revenue streams. The first is gaming operations. In 2025, gaming operations generated about 883.6 million euros of revenue. The second is licensing revenue, which was about 313.4 million euros in 2025. The annual report also says the B2B business accounted for 26% of group revenue during the year. So Betsson is mainly a B2C operator, but B2B is still meaningful and large enough to matter for results. The product mix is also very clear. In 2025, casino represented 72% of revenue, sports betting 27%, and other products 1%. Within casino, slots are the largest category, followed by live casino-style table games. On the geographic side, CEECA, meaning Central and Eastern Europe and Central Asia, was the largest region at 40% of revenue. Latin America was 27%, Western Europe 19%, the Nordics 12%, and the rest of the world 2%. That mix tells you something useful right away. Betsson is not a one-market company, and it is not a one-product company. It is a multi-brand, multi-region operator with a large casino base, a substantial sportsbook business, and a still important B2B layer sitting underneath. At the time of recording, the latest full set of financial results available is Betsson's year-end report for 2025, released on 5th of February 2026. For the full year 2025, Betsson reported group revenue of 1.19 billion euro, up 8% year-over-year, and the company described that as the highest revenue level in its history. EBITDA was 313.7 million euro, down 1%, with an EBITDA margin of 26.2%. Operating income, or EBIT, was 253.1 million euro, also down 1%, with an EBIT margin of 21.1%. Net income was 182.4 million euro, and earnings per share were 1.29 euro. Operating cash flow for the year was 215.6 million euro. The board proposed an ordinary division of 0.66 euro per share. So the headline is straightforward. Revenue reached a record level, but profit growth did not keep pace. Betsson became bigger in 2025, but not more profitable in absolute EBIT terms. Looking just at the fourth quarter of 2025, revenue was 303.9 million euro, down 1% year-over-year. Casino revenue increased 3%, sportsbook revenue decreased 9%, and the sportsbook margin was 8.8% compared with 9.8% a year earlier. EBITDA fell 20% to 69.3 million euros, and EBIT fell 24% to 53.2 million euros. Net income was 35.0 million euros. Active customers were 1.4 million. This is where the picture gets more interesting. Management said 2025 was characterized by continued strong customer activity and growth, but also by further investments to enhance the customer experience. In the CEO's own summary, Western Europe and Latin America continued to show strong growth, while growth slowed in CEECA and revenue from the Nordics declined. On the product side, casino stayed strong. Full-year casino revenue was 867.5 million euros, up 9%, while sportsbook revenue for the full year was 323.5 million euros, up 7%. But the fourth quarter was weaker on the sportsbook side, where revenue fell 9% and margin was less favorable than in the same quarter a year earlier. So the 2025 story is not that Betsson's whole model weakened. It is that some parts stayed strong, while some moved the wrong way at the same time. Management gave three main explanations for the pressure on profitability. First, lower B2B revenue, mainly because one of Betsson's B2B customers generated lower revenue than in the comparison period. Second, a higher share of revenue from locally regulated markets. That share rose to 68% in the fourth quarter, the highest ever, and it drove higher gaming taxes. Third, continued investments in product and technology, which pushed up personnel costs. Betsson's official view is that these investments should reinforce competitiveness over time, even though they weighed on near-term margins. That is an important point for viewers. More regulated revenue may sound safer and more sustainable, and strategically that is what Betsson is aiming for. But in the short run, that shift also increases gaming taxes and can pressure margins. So the company is balancing long-term positioning against short-term profitability. Betsson's official strategy is built around four growth areas: existing markets, new markets, B2B, and acquisitions. The company says its broad brand portfolio, proprietary technology, and sportsbook give it the flexibility to enter new markets quickly, while B2B offers further economies of scale. It also says its financial positions allows acquisitions that complement organic growth and strengthen the product offering. You can see that strategy very clearly in what happened during 2025. Betsson launched product offerings under local licenses in Brazil and Paraguay. It acquired BetClick Italy as part of its Italian expansion. It also bought the remaining shares in Bukmacherska in Poland. At the same time, Latin America continued to expand and accounted for 27% of group revenue, with Betsson opening a new office in Buenos Aires to strengthen its local presence in Argentina. There is also a branding angle here. Betsson's annual report says partnerships with clubs such as Inter and Boca Juniors are part of its marketing strategy, and that Betsson also signed a 3-year jersey sponsorship agreement with Club Brugge in 2025. So even if some viewers think they have never heard of Betsson, there is a decent chance they have seen the brand through football or other sports sponsorships without connecting that brand visibility to the listed company behind it. Now, we should move beyond the 2025 report because Betsson has already published a fresher update. On 9th of April 2026, the company released preliminary results for the first quarter of 2026. According to that update, revenue for Q1 2026 is expected to be 285 million euros, compared with 294 million euros in Q1 2025. EBIT is expected to be 34 million euros, compared with 64 million euros a year earlier. So the pressure on profitability did not disappear at the beginning of 2026. That regional picture in that preliminary Q1 update is mixed. Western Europe improved to 61 million euros from 56 million euros. Latin America improved strongly to 93 million euros from 75 million euros. But CEECA fell to 96 million euros from 122 million euros, and the Nordics fell to 31 million euros from 38 million euros. That means Latin America remains one of the clearest growth engines, while some of Betsson's older core regions were softer. The product and revenue mix also helped explain the weaker Q1 EBIT. Casino revenue was 204 million euros versus 212 million euros. Sportsbook revenue was 80 million euros, flat year over year, while sportsbook margin improved to 8.4% from 8.0%. But the B2B license revenue dropped sharply to 51 million euros from 90 million euros, and that was again mainly attributed to one B2B customer. At the same time, the share of revenue from locally regulated markets rose to 73%, the highest ever in a quarter, and gaming taxes rose to 53 million euros from 45 million euros. Gross margin fell to 57.6% from 64.0%. Management also gave some extra color that matters. Pontus Lindvall said the B2C business continues to perform well overall, but several B2C markets that Betsson is investing in are not yet profitable and currently reduce total quarterly EBIT by roughly 10 million euros to 15 million euros. He also said the B2B business continues to be weighed down by lower revenue from one customer, although activity at that customer has stabilized since early December. There was one more encouraging point in that same preliminary release. Betsson said average daily revenue in the second quarter of 2026, up to including 8th of April, was 9% higher than the average daily revenue of the full second quarter of 2025, and sportsbook margin at the start of the quarter had been higher than the rolling 8-quarter average. So the very latest signal from the company was somewhat better than the preliminary Q1 headline on its own. Betsson ended 2025 with cash and cash equivalents of 322.7 million euros. Outstanding bond loans were 173.2 million euros. In the quarterly reporting, the company described net debt as negative 157.7 million euros, which effectively means net cash. So this is not a balance sheet that looks stretched. That balance sheet strength is important because Betsson is still using capital actively. The board initiated a share buyback program of up to 40 million euros, and the company also proposed the ordinary dividend of 0.66 euros per share for 2025. Betsson has clearly been trying to combine investment in growth with shareholder returns. Then on 12th of March 2026, Betsson announced an agreement to acquire Rhino Entertainment Group B2C business in Canada, together with certain B2B technology assets. The purchase price is about 64.5 million euros, or around 4.7 times EV to EBITDA, based on 2025 pro forma results. Betsson said the target assets generated an estimated 13.7 million euros of EBITDA in 2025, that the upfront payment would be 51.25 million, and that the deal would be financed with existing cash resources. Betsson also said the front-end and middleware technology being acquired should strengthen its B2B offering. So again, the strategy is consistent. Existing markets, new markets, B2B, acquisitions. Betsson is not just talking about those pillars. It is still spending around them. Now, let's look at the share. When we checked Betsson's official investor information in mid-April 2026, the company site displayed a share price of 92.40 Swedish kronor, dated 13th of April 2026. Betsson's share page also shows a total of 142,729,838 shares outstanding. Based on that price and share count, the market value works out to roughly 13.2 billion Swedish kronor. As always, we are not using the chart or the share price to make a buy call or a sell call. It is simply part of the factual picture. This is a public company and the market is repricing it every day as new information comes in. So, what is the clean takeaway for episode 9? Betsson is a large, established consumer-facing iGaming group with real scale, a multi-brand portfolio, a proprietary platform, and meaningful B2B operations on top of its core B2C business. It is active across casino and sports betting, and it is geographically diversified rather than dependent on one single country. The 2025 results showed record revenue, but also showed the trade-offs inside the model. More locally regulated revenue helped support strategic positioning, but it also drove higher gaming taxes. Continued product and technology investment supported the long-term plan, but it also pushed up costs. And weakness from one major B2B customer dragged on profitability. The newest preliminary Q1 2026 update suggests that this story is still playing out. Latin America and Western Europe stayed relatively strong. B2C still held up overall, according to management, but B2B remained a pressure point and EBIT stayed weak. At the same time, Betsson is still acquiring, still investing, and still signaling confidence in medium term. This was Betsson, not a recommendation, not a financial advice, just the company, the products, and the latest official facts.